Hi, this is Dean Hoffman. I am the president and founder of DH Trading Systems, and I want to thank you for taking the time to tune in to this third in the video series, How to Successfully Trade the Futures Markets. As you can see, this video is going to be on trading psychology and how to maintain proper discipline. And as usual, before we get too far along here, I'd like to stop at the risk disclosure and remind everybody that commodity trading does carry risks and is not suitable for all investors. You should familiarize yourself with all the applicable risk disclosures prior to making a decision to invest in commodities. And let's go ahead and dig right into the material. And what we're going to talk about today is the importance of proper trader psychology. And let me just first of all make the point, as kind of the foundation for everything that we're going to talk about here today, that you can have the best systems and the best money management, but without the proper perspectives and discipline and trading psychology, you will very likely fail in your trading venture. Trading is emotionally a negative-sum game, and that's not my term. That actually came from William Eckhart. Some of you may be familiar with that name. He is a market wizard. He was profiled in that book, and he is arguably one of the most successful futures traders ever. He was partners with the legendary Richard Dennis of the Turtle fame. And what we mean when we say that emotionally trading is a negative-sum game is that winning never really feels as good as losing feels bad. They're not symmetrical. And this can cause an emotional slide that can eventually lead to mistakes. And let's just graphically kind of look at this concept a little bit deeper. Okay, in the graph that is before you, what we are comparing is the emotions of a trader versus his equity or her equity. And in this particular case, I've made it a point to really make the equity maintain at basically an even level. What you've got there is 18 different trades, and one of them is a small loss, one's a small winner, etc., so that you basically have a smooth equity curve. But you can see that in spite of this, the emotional state of the trader continues to slide downward. And the reason for this is, once again, the losers are taking a greater emotional toll than the winners are giving back. And up at the top, you can see I've said that trading is a little bit like boxing. And the reason I say this is that if you think about a boxer who is, let's say, winning, in spite of the fact that he may be throwing many more winning punches than he's receiving losing punches, he's landing more on them than they're landing on him. It doesn't change the fact that he is still getting a little weaker and a little weaker with each punch that comes in. And no matter how many winning punches he throws, the punches he receives are still going to drag him down a little bit more and more. So by the end, even if he's victorious, he's worn out. He's punch drunk. And it's kind of the same with trading. In spite of where your equity is going, even if your equity is going higher and you're being successful, there is still this slide in emotions because, again, as William Eckhart said, trading is an emotionally negative-sum game. And what you get emotionally from winning is never quite as much as what you lose from your losses. So this is kind of a constant slip. And the problem with this is, just like the boxer, you can eventually become punch drunk too, and as a result start to make errors in your judgment. One of the most common errors that we see time and time again is the tendency for investors to chase what's hot and abandon what's not. And essentially what happens, and this happens with trading systems, this happens with professionally managed futures accounts or hedge funds or stock accounts, you name it. This is a kind of a universal thing in investing. And in fact, a very good study on this was done by Jack Schwager, who's the guy that wrote The Market Wizards. And in his book about managed futures, they did a study looking at some very successful CTAs, or managed futures money managers. And what they found was that in spite of the fact that these managers in some cases had very long, successful, winning track records, they still had a large number of losing clients. And that's kind of a paradox when you think about it. You know, how is it that a winning manager who's got many years under his belt of doing well has got so many losing clients? And the answer is really rather simple, and it's represented right here in this graph. You can see in this graph that in spite of the equity curve moving higher for many years, you know, let's say in this case those numbers represent years, so 9 years, investors will have a tendency to buy at the peak, chase what's hot. And when people look at my managed futures account or my trading systems or anybody else's, you know, the first thing they want to know is, how's it doing? You know, how's it done the last year? How's it done the last 3 or 6 months? And if it's done well, they're interested, and if it's done poorly, they're not interested. And this just creates all sorts of errors, because once again, what ends up happening, and you know, you can really see this when you graph the equity infusions into a trading system or a money manager against the equity curve, and you can see that the vast majority of new clients will enter that program right at an equity peak. And then what will happen is inevitably the program will go through a drawdown, because I don't care how good somebody is, how good a trading system is, how good the money manager is, eventually they all have drawdowns at some point. And if you've bought in at a peak, you're probably getting started right before the drawdown's getting ready to begin, and you know, you go through 3, 4, 5, 6 months, you know, who knows, maybe a year of a drawdown, and you've had it, and you get out and you sell out of that investment right at the low point, right before it's getting ready to take off again. And we see this time and time and time again. And so the point here, and what to take away from this, is that you should separate the process of determining what is a good investment from the timing of when to get in it. I'm not simply suggesting you just buy something that's losing just simply because it's losing. It may be losing because it's a lousy program. But if it's a good program that's done well over a long period of time, you know, has a long track record of success, but it's temporarily, and that's the key word there, temporarily going through a losing period, many times or oftentimes that is the very best possible time that you could be getting started. So again, something from the trading psychology book here, and this is one of the concepts. Don't chase what's hot.